One interest rate hike broke Japan for 30 years. Now the same shock is hitting every major economy at once. Over the weekend, Iran's naval forces struck a container ship transiting the Strait of Hormuz and declared the waterway closed again, the same strait that carries roughly a fifth of the world's oil. It's the latest flare-up since President Trump declared the ceasefire that briefly calmed this war down back in April, officially over earlier this month.
Is the ceasefire done? Is the MOU dead?
It's a very interesting question. To me, I think it's over.
And it's landing on a bond market where long-term borrowing costs are already at their highest level in almost 20 years. Normally, a headline like that spikes oil for a day and fades. This time, it matters a lot more than usual. And whether or not you've ever bought a bond in your life, you should care, because bond yields are quietly the most important number in the entire global economy. Here's why. When investors get nervous about inflation, about war, about a country's finances, they demand a higher rate to compensate. Yield up means trust down. That's really the whole concept. And this isn't a one-country problem. On May 19th, the yield on the U.S. 30-year Treasury hit 5.2%, its highest level since July 2007, right before the financial crisis. Japan's long bonds are at levels the country hasn't seen since the 1990s. UK 30-year gilts are near their highest since 1998. Germany's 30-year yield now sits at roughly 7 times the growth rate the German economy is actually expected to deliver this year. This is a global rate shock, not an American one. The trigger is the Iran war. Since February, fighting between the US, Israel, and Iran has repeatedly shut down the Strait of Hormuz, taking a fifth of the planet's oil supply offline with it. Crude spiked past $100 a barrel in the spring, eased back into the 70s as ceasefires came and went, and is climbing again now that the fighting has flared back up. That feeds straight into inflation. U.S. consumer prices rose 3.8% in April. Producer prices hit 6%, the worst reading since the last energy shock in 2022. Higher inflation means anyone lending money for 30 years wants to be paid more to compensate, because nobody wants to lock in a fixed return for 3 decades if they think it's about to get quietly eaten alive. Here's the part that matters even if you've never looked at a yield curve. The 10-year Treasury sets the price of your mortgage. It climbed to 4.57% just days ago. Every corporate loan, every car loan, every business expansion gets priced off this same curve. When it moves, the cost of almost everything moves with it. A huge chunk of the money funding the AI data center boom, hundreds of billions of dollars, has been pushed off big tech's balance sheets into what's called private credit, loans arranged outside the traditional banking system, almost all at floating rates. Morgan Stanley estimates the AI build-out will need around $800 billion of this kind of financing by 2028. Meta alone signed a $30 billion deal for a single data center in Louisiana, the largest private credit transaction on record. If rates stay elevated, the interest bill on all of that infrastructure rises automatically, right at the moment those companies need it to start paying off. Now, heavily indebted companies could find their financing costs climbing at the exact moment their revenue growth is slowing. Not an ideal combination. Which brings us to equities. And this is where the mood in markets gets genuinely strange. The S&P 500 has notched more than 20 new all-time highs in 2026 alone, recently crossing 7,600 for the first time ever. Chip and AI names have driven most of it. Micron is up over 200% this year by itself. And JP Morgan has warned that crowded, momentum-chasing positioning is raising the odds of a sudden, sharp flash crash. And notice what's barely getting talked about anymore. Bitcoin. It peaked near $126,000 last October and has since been cut roughly in half, sliding to around $60,000. That money didn't just vanish. A lot of it rotated straight into AI stocks and into the safety of the dollar and treasuries, which now pay real interest that Bitcoin doesn't. Crypto used to dominate the FOMO conversation. Right now, stocks have swallowed it whole. Underneath those record highs, though, market breadth has quietly collapsed. Strip out a handful of AI giants, and the rest of the S&P 500 has barely moved in a month. Roughly 94% of recent gains have come from that same tiny group of mega-cap tech names. Here's why higher yields are dangerous for that setup. Flip a stock's price-to-earnings ratio upside down, and you get roughly its expected annual return. A market trading at 33 times earnings is basically promising you about 3% a year. If the US government is now offering a guaranteed 5% for lending it money over 30 years, that 3% stops looking very attractive. The math only still works if future profits grow enormous enough to justify the gap. It doesn't mean the market crashes. It means that gap has to keep closing itself somehow. And rising yields are exactly the kind of pressure that forces the reckoning. Bank of America has made the same point directly. A Fed rate hike now would land differently than past cycles because stocks have rarely been this expensive heading into one. The only real precedent is 1999 into 2000, right before the dot-com crash. Then there's the biggest borrower of all, the government itself. U.S. interest payments on the national debt crossed $1 trillion for the first time in 2024 and have kept climbing. That's now more than America spends on its entire military. Normally, a central bank fights inflation by hiking rates. The problem is that America's debt is now so large, over 100% of GDP, that aggressively hiking would make the interest bill on that debt genuinely unaffordable. Jamie Dimon put it bluntly this year. U.S. debt stands at around $30 trillion at an average interest rate of 3.5%. And even today, the government can't refinance it any cheaper than that, with rates likely headed higher, not lower. Economists have a name for this trap: fiscal dominance. It's the point where a government owes so much that its own central bank can't do the one job it exists to do, because doing it would blow up the budget. So here's where things actually stand. Oil is climbing again after this morning's news. The ceasefire looks broken. Inflation is running hot. And the 30-year Treasury has spent the summer bouncing right around that painful 5% line. None of this is necessarily a collapse. The dollar is still the world's reserve currency. The Treasury market is still the deepest on Earth. And there's no real alternative for global investors to run to at scale. What we're watching is closer to an adjustment. An expensive, uncomfortable one, but an adjustment. So what actually breaks first? The debt or the market? Probably not the debt itself. The more fragile side is the stock market. A handful of AI names holding up the entire index. Valuations that only work if future profits grow enormous enough to close the gap with a guaranteed 5% from treasuries. If something cracks first, that's probably where.